Thank you very much for inviting me today and listening to my talk. My name is Melina Heinl-Powell, and I'm the head of our growth markets here at Preqin. Before we begin, a quick introduction to Preqin, for those who might not know who we are. Preqin is a global leader for alternative data, covering everything on investor appetite, fundraising, performance, and deal flow. Our team spans 14 global offices currently, and we are focusing on engaging with investors, fund managers, and service providers to provide our customers with the highest quality data to help them with the investment decisions. In terms of my presentation today, every 2 years, Preqin releases a report that tries to predict what is happening in the next 5 years. Traditionally, our responses is universally positive. Lots of talk about investor appetite, growth of the market, and fundraising records being broken. And while we certainly still remain positive, we must also recognize both the short and long-term implications of the headwinds that the world is facing currently. As a result, investor appetite on the outlook for the alternative assets industry is shifting for the first time in many years. However, before I dig deeper into the shifts and the finding of the report, I do want to spend some time setting a scene to better visualize how the alternative market stood coming into 2020, with a focus on private equity and venture capital. As you can see here, the private equity industry, the alternative assets industry has been experiencing an unprecedented period of growth. Preqin is now tracking 21 institutional and private wealth investors who are actively investing in alternatives, 13,000 alone in private equity and venture capital, who have flocked to the market in search of portfolio diversification and higher yields. This is up from 3,000 investors a decade ago. And as a result, global AUM has surged to just over 13.6 trillion by the end of 2021, which represents a 11.3 year-on-year growth since 2015. This is a slightly slower growth than we have seen in the previous 5 years, but this is largely due to the slowdown in the expansion of the hedge fund industry. When we remove hedge funds from the picture and focus on private capital, the pace of growth is way more significant, with a record high of private capital AUM of 9.3 trillion. Private equity, when including venture capital, has overtaken hedge funds as the largest alternative assets industry, with private equity and venture capital firms now managing a combined 5.7 trillion in assets under management. This is an industry 3 times larger than it was in 2010. Despite the uncertainties caused by the COVID pandemic and the impact it had on the GP ability to raise capital, private capital fundraising rebounded strongly in 2021. Fundraising bypassed the 1 trillion mark for the second time, reaching a record of 1.3 trillion, and private debt and venture capital seeing 42% increase in capital raised versus 2020. From a regional perspective, in Asia, the Asia grew by 54% in 2021, having suffered considerably in 2020 due to the early offsets of the pandemic. Fundraising in Europe actually grew slightly in 2020 off the back of several sizable fund closures and accelerated again in 2021, representing back-to-back record fundraising years for European managers. So this is a brief overview of how the market stood before we came into 2022. Lots of strong market tailwinds, which have been feeding the investor demand and the industry growth. However, 2022 feels quite a different place now. The tailwinds that have been helping to accelerate the growth of the market over the coming decade are being quickly eroded in the last recent years, and the macroeconomic picture has deteriorated significantly since our previous forecast back in 2020, which is quite surprising because it was in the depth of the pandemic. And as a result, investor preferences within alternatives are shifting. While in the last years, investors have been satisfied with the performance seen by the private capital investments, a comparatively high proportion of LPs are expecting performance to worsen over the next 12 months. As you can see here, investors expect private equity and venture capital to face the strongest headwinds, with 50 and 55% of respondents expecting worse performance over the next 12 months. For the first time in years, LPs are bracing themselves for a sustained period of slower growth and softer performance. Asset valuation remain a significant area of concern for investors. Private markets are going through a pricing adjustment, and as exit multiples continue to come under increasing pressure, fund performance is expected to decline. Venture capital-backed companies in particular bid up to eye-watering valuations during the post-pandemic stimulus measures and have since seen heavy corrections. We think a scenario whereby risk assets are placed at a lower valuation multiples is likely for longer term, combined with long holding periods, and this will inevitably weigh on future performance. Exit environments, asset valuations, rising interest rates, and stock market volatilities are all contributing factors and paint a much more challenging environment for both fund managers and investors alike. And as a result, investors are now firmly on a risk-off mode. And this comes on the expansion of higher risk asset classes such as venture capital and private equity. The result of our H2 investor survey clearly shows that LPs are more optimistic towards asset classes such as private debt, infrastructure, and hedge funds, which they perceive to provide a greater stability during market turmoil. As you can see here, planned LP investments into PE and VC are considerable down at the margin. The proportion of investors looking to deploy more capital in private equity and venture capital over the coming year has dropped by 13 and 17 points respectively since July 2021. So what does this all mean for the future of the growth of the market over the next 5 years? The following slides provide more insights into the findings of our latest report, including forecasted AUM, fundraising, and performance modeling conducted by our research insights and data science teams. As many investors are already predicted, we do indeed expect macroeconomic headwinds to weigh on private capital performance between now and 2027. Our latest forecasts expect private capital performance to soften globally, with North America having the largest proportion of drop in comparison to the 5-year period, ahead of both Europe and APAC. However, the pink bars in the middle show how strong private capital has been performance over the last 3 years, especially. In terms of asset classes, we are expecting to see the sharpest drop in private equity and venture capital, especially when compared to the annualized performance seen since 2018. Yet performance in both private equity and venture capital are still predicted to outpace any of the other asset classes. As a result of slowing performance and downside risk emerging from within private markets, we expect the pace of fundraising to slow down significantly. Following a 33% jump in global private equity fundraising in 2021, we expect a 22% decline this year before a further 3% reduction in 2023. We then forecast relatively modest annual growth coming up to 2027. In contrast, we actually expect venture capital fundraising to increase slightly in 2022, despite an overall drop across the globe. Our model predicts that VC fundraising will grow around 9% to 195 billion by the end of this year, followed by steady growth up to 2027. However, as I've mentioned right at the beginning, the decline is relative, and Preqin is hugely optimistic, despite the clear and obvious challenges we are currently facing. While the pace of the expansion will slow, and this is hardly surprising given the exceptional growth we've seen over the last decade, and especially the last 3 years, as a result, we expect global alternative AUM will continue to climb to record highs despite the slowdown we've seen. Alternative AUM is expected to exceed 23 trillion by the end of 2027, which represents a 9.3 year-on-year growth which is slower than the 11.3 growth we have seen since 2015, but an industry still 55% larger than it is today. So in summary then, the alternative assets industry is bigger than ever. Assets under management stand at 13.6 trillion, We're coming off the back of a record fundraising year in 2021, and performance has been largely meeting and exceeding investors' expectations. However, clearly the route ahead is significantly more uncertain and difficult. The deterioration macro environment is causing near-term performance concerns, and investors changing their plans and expectations accordingly, with many shifting to risk-off mode and expectation to slow pace of new fundraising. Alternative assets remain, however, strong. Yes, the pace of the growth will slowly, steadily down in the coming 5 years, but Preqin remains highly optimistic about the future of the industry, with alternative AUM forecasted to exceed 23 trillion by the end of 2027. And with this, I'm coming to an end of my presentation. Thank you very much for listening, and I hope you have a good rest of the event. Thank you.